Good day, my viewers. My name is Olapoju Bamidele. I'm here to present to you today tax implications of changes in Nigeria tax law for banking and capital market sectors in Nigeria. In accordance with the Finance Bill 2020, the following are the major changes taxpayers in these particular industries, banking and capital market sector, must pay attention to. Number one, introduction of electronic money transfer levy, EMT. Section 89, subsection 3 of Stamp Duty Act has been modified by removing electronic transfer from the scope of stamp duty and introduced an electronic money transfer levy, which is applicable on electronic receipt or electronic transfer for money deposited in a financial institution on any type of account. The applicable level is 50 naira or any transfer of 10,000 or more. So if you have a credit receipt of 10,000 naira or more into your account, definitely it comes with a levy of 50 naira. That's a debit to your account, which is referred to as electronic money transfer levy henceforth. 2. Unclaimed dividends of publicly quoted companies and unutilized funds in dormant accounts of deposits monies in bank. Depositors' money in banks. Shareholders are only allowed to claim dividends declared by their company within 12 years. Otherwise, such dividends revert to the company to be distributed to other shareholders. 3. Unclaimed dividends of a public limited liability company quoted on Nigeria Stock Exchange for a period of 6 years or more after declaration are to be transferred to the Unclaimed Fund Trust Fund, UFTF. Such unclaimed dividends shall be treated as a special debt owed by the federal government and will be available to be claimed by the rightful shareholders at any time from that same fund. Banks are required to transfer any unclaimed balances in dormant account outstanding for at least 6 years to the UFTF. All publicly listed companies on the Nigeria Stock Exchange and Debt Management Office are required to render returns to the DMO accordingly. 4. Banks to benefit from tax incentives on loan granted for primary agricultural production purposes. Previously, loans granted by banks for any agricultural trade or business are eligible for incentive, that is tax-free on interest income earned on such loans. The latest amendment has restricted the incentive to only primary agricultural productions defined as primary crop production, primary livestock production, primary forestry production, and primary fishing production. The Act further reduces the moratorium period from 18 months to 12 months to encourage banks to provide these loans. In other words, government wants to encourage farmers, people in agricultural sector, primary production, and that is why government is granting tax-free on every interest income earned by banks, on loan given to such farmers, players in that sector. But at the other side, to encourage bank, apart from the incentive of tax-free interest income, they also reduce the moratorium period, the grace period for repayment, from 18 months to 12 months, so as to encourage bankers to give. So this is just like killing a two birds with one stone. Encourage farmers to get more loan, encourage bankers to give more loan for the purpose of production in the agricultural sector. Now, effective date for the implementation of this is January 1st, 2021. So if you are a player in that sector and you require impact assessment report, or you require some professional advice on how to implement this and how to make best out of these laws for your organization, so please call us today through the numbers on the screen or send us an email. I'll be glad to respond to you appropriately. Thank you so much.